Welcome back to the Deep Dive. It is Tuesday, January 27, 2026. Today, we're doing something a little different. Usually, we're looking at the flashy stuff, AI, biotech breakthroughs, the things that make the front page. But today, we're looking at cardboard boxes.
Yeah, we are.
We are looking at exam gloves. We are looking at the plumbing of how a hospital actually functions. And we are doing that by unpacking what is, I think, arguably the most significant business story of the last 12 months that almost nobody outside of Wall Street is really talking about.
It is a story that sounds, on the surface, just so boring.
Right, logistics.
Logistics, distribution. But then you start to peel back the layers and you find this incredibly sophisticated, almost predatory business model that has just quietly taken over the healthcare industry.
We are talking, of course, about Medline Industries. Now, if you have ever been in a hospital or even just a dentist's chair, you have seen their logo.
Oh, for sure.
It is that blue font on the surgical gown, the plastic wash basin, the wrapper on the gauze. I mean, they are just everywhere. But until December of last year, December 2025, they were basically a ghost, a massive family-owned private company.
The quiet giant. That's what the industry called them.
Quiet giant, yeah.
The Mills family ran it for decades. They didn't do earnings calls. They didn't have to explain themselves to analysts. They just grew.
Until they decided to go loud.
Very loud.
Very loud.
Yeah.
They pulled off the largest IPO of 2025. They raised $6.26 billion.
$6.26 billion.
That is just a staggering number for a company that sells bedpans and bandages.
It is. And to understand why investors were willing to put up that kind of money, you really have to look under the hood. Because Medline isn't just a distributor. They aren't just a trucking company moving other people's stuff.
Yeah.
And they aren't just a manufacturer. They have built this hybrid model that their CEO, Jim Boyle, he calls it the Costco of healthcare.
I love that analogy. It's the hook for this whole episode, really.
Yeah.
When you think Costco, you think membership fee, bulk buying, and, well, chaotic parking lot.
Yeah.
But mostly the business model.
Exactly. Think about the core of what Costco is. You have the membership, right, that locks you in. That's your recurring revenue stream right there.
Right.
And then inside the store, you've got the big name brands, your Sony TVs, your Tide detergent, all that stuff. But right next to them, you have Kirkland Signature.
Which is Costco's own private label.
Right.
It's usually made in the exact same factory as the name brand. It's high quality. It's cheaper for me. But, and this is the absolute key, it is vastly more profitable for Costco.
Exactly. That's the whole play. And Medline is running that exact same playbook, but they're doing it in operating rooms instead of, suburban warehouses.
So what's their membership?
They have these prime vendor contracts. That's the membership.
And their Kirkland Signature.
That's the Medline brand.
Okay, so today we're going to tear apart this dual engine model. We have the IPO prospectus, which is a beast. We have the transcripts from the JP Morgan Healthcare Conference from just a few weeks ago. And we have the data on, was it $2.1 billion in new contracts they just signed?
That's right.
So we are going to figure out how they win, but we also have to talk about the risks. Because this is 2026.
Yeah.
Trade wars are back. Tariffs are very real. And when your entire business model relies on moving physical goods across borders, that is a massive, massive vulnerability.
It is the elephant in the room.
It really is.
A $500 million elephant, as it turns out. But we'll get to that.
Okay, let's start with the basics. The dual engine.
Mm-hmm.
This is the core thesis of the company.
Mm-hmm.
You mentioned they are not just a distributor and not just a manufacturer. They have this term for it, the N of one concept. Break that down for us. Why is being both such a big deal in this space?
So to really appreciate the N of one idea, you have to look at the competition. In healthcare distribution, you typically have two very distinct animals. On one side, you have the pure distributors. We're talking giants like McKesson, Cardinal Health, AmerisourceBergen. These companies are logistics beasts. Their entire job is to move a box from point A to point B as efficiently as possible.
They are essentially trucking and warehousing companies with a medical license.
Precisely. That's a great way to put it. They don't really care what's inside the box. They just charge a fee to move it.
And because of that, their margins must be razor thin.
Oh, they're tiny.
Oh.
They are competing on, fuel costs and warehouse efficiency and labor rates. It's a grind. Then on the other side of the canyon, you have the manufacturers. So companies like 3M, Becton Dickinson, Stryker. They're the ones who design the product. They engineer the hip implant or the specialized catheter. They have huge R&D budgets.
There are huge margins to go with it.
Huge margins, but they have a problem. A big one, getting that product to the customer.
They have to rely on the distributors, on the McKessons and Cardinals of the world to actually put it in the doctor's hand.
Right. So you have this dynamic where the manufacturer makes all the profit, but the distributor owns the customer relationship. Medline looked at this landscape and just said, why choose?
We'll do both.
We'll do both. So they built this dual engine model. Engine one is what they call supply chain solutions. This is the distribution side.
Okay, so let's look at the financials of Engine 1 then. Based on the 2024 numbers from the prospectus, this accounts for about half their revenue, right? Roughly $13 billion.
That's right, about 50%. It's a massive top-line number.
But the margins, I mean, looking at this, they aren't very exciting, are they?
No, they are classic distributor margins. The adjusted EBITDA margin for that supply chain solution side is only about 5%.
5%.
5%. If you were a standalone business making 5%, Wall Street would probably ignore you. It's a low margin, high hassle, high volume grind.
So why do it? Why would you even bother? Why slog through the mud for a 5% margin?
Because Engine 1 is the Trojan horse.
Oh, okay.
This is the hook. Hospitals are incredibly complex, chaotic environments. They need reliability above all else. They just need it to work. They need a truck showing up at their loading dock at 4 a.m. every single morning with exactly the right amount of saline solution and sterile drapes. If Medline can provide that logistics perfection, they get the contract. They get inside the building.
And once they are inside the building, that is when Engine 2 gets turned on.
That is exactly when Engine 2 roars to life. Engine 2 is the Medline brand. This is the profit driver. Over the last few decades, Medline has quietly built up this massive portfolio of its own products, over 190,000 of its own SKUs.
190,000, that's not a small operation.
It's enormous. And we aren't talking about, high-tech MRI machines or robotic surgical arms here. We are talking about the consumables, the everyday stuff.
The stuff that gets used and thrown away after every single patient.
Correct. The high-volume stuff. Surgical kits, gowns, gloves, wound care, incontinence products, things like that. Now, this segment also brings in about 50% of the revenue, so another $12.5 billion or so.
So it's an even split on the top line.
An even split. But the margin profile is completely different. The adjusted EBITDA margin here is roughly 26.1%.
Well, wait, say that again?
26.1%.
So 5% on the distribution side versus 26% on the manufacturing side. That is a massive spread.
It's night and day. It's a fundamentally different business. And that spread is the secret sauce. That's the whole magic trick. The low-margin distribution business exists solely to create a protected, exclusive channel for the high-margin manufacturing business.
Because they control the trucks and the warehouses, they don't have to pay a middleman to sell their own stuff.
Right. They don't have to share. They capture the manufacturing margin, and they get the efficiency of their own distribution network. It's a beautiful integrated system.
It feels vertically integrated, but it almost feels sneakier than that.
Sneaky is a good word for it.
If I am a hospital administrator, though, I'm a smart person. I have an MBA. Yeah. I assume I can see this happening. Why do I let Medline do this? Why do I agree to switch from my trusted 3M mask to their, generic brand? Is it just about the price?
Price is the headline, absolutely. Of course it is. Because Medline controls the manufacturing cost, often in their own factories overseas, they can undercut the big-name brands like 3M or Kimberly-Clark pretty significantly. They can walk into your office and say, look, we can give you a glove that meets the exact same FDA safety standards, feels the same to the doctor, performs the same, but it costs 15% less.
And in a world where a lot of hospitals are literally operating on negative margins, which many of them are right now, the 15% is not just a nice to have, it's a lifeline.
It is. It's the difference between ending the year in the red or in the black. But it's also about simplicity. This goes back to that N of 1 value proposition. Think about it this way. If I buy my 3M masks from a distributor like Cardinal Health and the shipment is late, who's at fault?
Cardinal blames 3M for a production delay. 3M blames Cardinal for a logistics screw-up.
And you, the hospital, are stuck in the middle with no masks.
Right.
Now, if I buy Medline masks from Medline and the shipment is late, there is only one phone number to call. There's only one throat to choke.
That accountability has real value.
Massive value. It simplifies the absolute procurement nightmare that most hospitals deal with every single day. Medline goes in and guarantees a 99% service level.
99%.
That means 99 times out of 100, the product you ordered is on the shelf when you need it. In this industry, that kind of reliability, it's gold. It's everything.
Let's talk about how they actually achieve that reliability, because you can't just promise 99%. You have to build the infrastructure to deliver it. This brings us to what you might call their moat.
Hmm.
In tech, we talk about network effects or a proprietary algorithm as a moat. Medline's moat is made of concrete and diesel fuel.
It is a physical fortress. It's incredible. We are talking about 29 million square feet of warehouse space globally.
29 million? It's hard to even picture that.
To put that in perspective, that is about 500 football fields, just stacked with medical supplies. But the real differentiator, the thing that I think scares their competitors the most, is the fleet.
The Medtrans fleet.
Yes, they own a private fleet of over 2,000 trucks.
Okay, so you might ask, so what? I mean, FedEx exists, UPS exists. Why do you need your own private navy of trucks?
That's the question everyone asks.
I was just about to ask that. Amazon uses third-party carriers all the time for a lot of their stuff.
Yeah.
Why does Medline feel the need to own the wheels?
It comes back to the nature of the customer and the cost of failure. A hospital is not a retail store. If you order a new pair of headphones from Amazon and it comes a day late, you're annoyed, maybe you leave a bad review.
Right, it's an inconvenience.
It's an inconvenience. If a hospital orders a custom surgical pack for a heart transplant and it comes an hour late,
That surgery is canceled.
the surgery is canceled, the operating room goes dark, the surgeon and the whole team are idle. The patient, who's been prepped and is incredibly stressed, has to be sent home, and the hospital loses tens of thousands of dollars in revenue. Just like that.
The cost of failure is astronomical.
Exactly. So by owning the trucks and employing the drivers, Medline controls that last mile. They control their own destiny. They aren't at the mercy of a common carrier who might be delayed by a snowstorm in Denver or a routing error in Memphis or, a labor strike. They can prioritize their own shipments. They can guarantee delivery.
And the drivers, I was reading something interesting in the prospectus about this. The drivers aren't just steering the wheel. They do something called put away. What is that?
Right. This is such a great little detail that shows how deep their integration goes. A typical UPS or FedEx driver drops the box at the loading dock, gets a signature on a tablet, and leaves. They're gone.
Yep.
A Medtrans driver, in many cases, will take the pallets off the truck, navigate the maze of hallways in the hospital basement, and actually stock the shelves in the supply room.
So the driver is almost like a Medline employee who works inside the hospital.
That's exactly what they are. They become part of the hospital's workflow. They know the nurses. They know where everything goes. They see what's running low.
That makes them incredibly sticky.
Oh, unbelievably sticky. Once a hospital gets used to that level of service, where the supplies just magically appear on the shelf where they're supposed to be, they do not want to go back to sorting through a giant pile of cardboard boxes on a chaotic loading dock.
That is a powerful sales pitch. Don't trust your critical life-saving supplies to a third party. We own the truck, we employ the driver, we stock the shelf. It just removes all the friction.
Friction reduction is the name of the game, and there is one product category that exemplifies this whole strategy better than anything else.
And that would be the sterile surgical kits.
The surgical kits. This is the anchor product.
So Medline is the world's largest manufacturer of these things.
They are. Think about a surgeon who's preparing for a very specific procedure, let's say a total knee replacement. For that one surgery, they need dozens and dozens of specific items. Drapes, scalpels of a certain size, sponges, sutures, suction tubing, marking pens. The list goes on and on.
And in the old days, where with a more basic distributor, a nurse would have to go to the supply room with a long checklist and pick all those items individually. One of these, two of those.
Which takes a huge amount of time. And it's prone to human error. Noops, I forgot the size 10 scalpel, or I grabbed the wrong kind of suture.
And that error could delay the surgery.
Right. So Medline sits down with the surgical team at the hospital and designs a custom kit. They say, Dr. Smith, what exactly do you want for your specific knee replacement procedure? They put all of it, in the right order, into one single sterile pack. The nurse just has to peel back one cover and everything is there, ready to go.
That sounds incredibly convenient for the clinical staff, but also incredibly locking for the hospital.
It is the ultimate lock-in. Once Dr. Smith gets used to her Medline knee kit, she does not want to switch. It's tailored to her specific workflow. It makes her faster and more efficient. And because Medline manufactures the kit and most of the components inside it, they capture a high margin on every single item in that pack.
So the kit is the wedge that gets them into the operating room, which is the most profitable part of the hospital.
Exactly.
And once they're in the OR, that opens the door for everything else.
Yeah.
This leads us to the strategy they call the conversion curve. This is the playbook for how they grow revenue without even finding new customers.
Right. This is where the Costco analogy evolves into something a a little more aggressive. It is not just about letting you shop. It is about actively guiding what you buy.
So walk us through the life cycle of a customer. Day one, I am a big hospital system, let's call it General Hospital. I decide to sign up with Medline. What is the first thing that happens?
Okay, so step one is acquisition. You sign a prime vendor contract. And this is a massive commitment. You aren't just buying a few things from them, you are agreeing, in writing, to buy roughly 85% to 90% of your total medical surgical supplies from Medline.
90%. That is practically a marriage.
It is. It's a deep, deep partnership. You are essentially outsourcing your entire supply chain to them.
And in exchange for that commitment.
In exchange, Medline gives you pricing stability and that logistics reliability, that 99% service level that we talked about. Because the commitment is so deep and so integrated, the retention rates are just absurd. We're talking 98% to 99%.
So once you're in, you basically don't leave.
You don't leave. The switching costs are enormous.
Okay, so I've signed the deal. Medline is my partner. My trucks are showing up every morning. What is step two?
Step two is a great little phrase that management uses. They call it sweeping in the corners.
I like that visual. What does that mean in practice?
Well, even after signing a big prime vendor deal, a hospital is a messy place. They might still be buying random things directly from other manufacturers.
Oh, right. Like legacy contracts.
Exactly. Maybe the urology department has always bought a specific catheter direct from the supplier because, that's just how they've always done it. Or the lab buys special test tubes from some niche distributor. Medline's data team goes through the hospital's purchasing records and says, hey, we are already sending a truck to your dock every single day. Why are you paying separate FedEx charges on those catheters? Let us buy them for you, put them on our truck, and consolidate everything.
So they vacuum up all that loose, fragmented volume.
That's a perfect way to put it.
They simplify the hospital's accounts payable, fewer invoices to process, and they get to push more volume through Engine 1, their distribution business.
Exactly. But remember, Engine 1 is the low-margin business. Sweeping in the corners builds the top-line revenue, but it doesn't really explode the profits. The real moneymaker is step 3, brand conversion.
This is where we swap the Sony TV for the Kirkland TV.
That is it. That is the whole game right there. The data shows that when a new customer first joins Medline, historically, only about 13% of their total spend is on Medline brand products.
13%, okay.
So the vast majority, 87%, is them buying the third-party stuff, the Johnson & Johnson sutures, the Becton Dickinson syringes. That Medline is just distributing for that tiny 5% margin.
Got it. So they're making that low margin on most of the initial order.
Right. The entire goal of every single Medline sales rep, and they have an army of them embedded in these hospitals, is to push that 13% number up. Their job is to find opportunities to swap out a 3M mask for an equivalent Medline mask, to swap out a Kimberly-Clark gown for a Medline gown. Management has a target of converting up to 60% of a customer's spend over to the Medline brand.
From 13% to 60%.
From 13 to 60.
And just to remind everyone, the margin jumps from 5% to 26% on every single dollar that converts. That is pure, unadulterated profit falling straight to the bottom line.
That is the magic. And here is the number that should make any investor just sit up straight. We pulled this from the prospectus. They estimate there is a $4 billion sales opportunity just within their existing customer base, simply by switching them from third-party products to the private label.
$4 billion.
$4 billion. And that translates to roughly $1 billion in incremental gross profit without signing a single new client.
That is just wild. They don't even need to go out and find new hospitals. They just need to convince the ones they already have to switch brands.
It's the ultimate same-store sales growth on steroids.
And because they're already inside the hospital, their people are walking the halls, managing the inventory in the supply closets. They have the perfect platform to make those sales pitches.
That's the key. The sales rep isn't some stranger calling on the phone. They are the person who fixed the inventory problem in the supply room last Tuesday. They have the trust.
They can say, hey, I see you're using this. Try our glove. It's just as good, and it will help you hit your department's budget savings goal for the quarter.
It's insidious in the smartest possible way.
Okay, so that is the playbook. It's incredibly powerful. Now let's talk about how it is actually playing out right now, because 2025 was, by all accounts, a monster year for them.
It really was. Leading up to the IPO, they just had this incredible, undeniable momentum. In the first 9 months of 2025 alone, Medline signed $2.1 billion in new prime vendor contracts.
Well, put that number in context for us. Is that a normal amount?
No. Not at all. Their historical run rate, what they would typically do in a full year, is about $1 billion in new contracts.
So in just 3 quarters, they more than doubled their typical annual performance.
They doubled it. It was a massive acceleration.
What drove that? Was it just that they had great salesmanship all of a sudden?
It's a combination of a few factors, I think. One, the market is consolidating. Like we said, hospitals are getting bigger, and they want to deal with fewer, larger, more stable partners. Two, the economic pressure on hospitals is intense. It's forcing them to look for those kinds of savings that Medline's private label can offer. And three, honestly, some of their main competitors have stumbled a bit.
We have heard reports of service and reliability issues with some of the other big distributors. Supply chain disruptions post-pandemic.
Exactly. So when a competitor starts missing deliveries, Medline's physical moat of those 2,000 owned trucks looks very, very attractive. Hospital CEOs and CFOs start asking their teams, why are we dealing with these constant delays when Medline is out there guaranteeing 99%?
Now, here is where it gets interesting for the financials and for anyone looking at the stock. We see this big headline number, $2.1 billion in new contracts signed. But if you look at the actual revenue for 2025, you don't see a sudden $2.1 billion spike. Why is that?
This is what they call the lag effect. And it's actually a really positive thing for future visibility. These contracts are huge and complex. You don't just flip a switch on day one and the hospital buys everything from you. It takes time to onboard a massive hospital system, to change out all the inventory in their storerooms, to design and roll out those new custom surgical kits.
So the money doesn't all flow instantly on the day the contract is signed.
No, not at all. The formula Medline gives investors is roughly 20-60-20.
20-60-20, what does that mean?
It means they realize about 20% of the contract's annual revenue in year one. They realize the bulk of it, about 60% in year two as everything gets fully ramped up, and then the final 20% ramps up in year three.
So if they signed all these massive deals in 2025...
It means 2026, this year, is going to be a very, very good year for them on the top line.
And 2027 as well.
And 2027. That massive bolus of wins from 25 is going to hit the P&L primarily this year and next. It creates this beautiful locked-in growth layer. Investors absolutely love visibility. And Medline essentially has its revenue growth for the next 18 to 24 months already signed on the dotted line.
That explains a lot about why the stock has been performing pretty well since the IPO.
Yeah.
The market can see that guaranteed growth baked in.
But speaking of the IPO, we really need to talk about why they went public in the first place. Because for so long, this was a famously private family-owned company. Then it was a private equity-owned company. Now it is public. What happened?
Right. The history here is really important to understand the story today. The Mills family built this company from the ground up over generations. Then in 2021, at the absolute height of the cheap money zero interest rate era, we saw that massive leverage buyout, the LBO. Blackstone, Carlyle, and Hellman & Friedman, some of the biggest PE firms in the world, took the company private for $34 billion. It was one of the biggest LBOs of that era.
And LBOs usually mean one thing above all else: debt. Lots and lots of debt. That's the private equity playbook, right? They mortgage the house to buy the house. Before the IPO, Medline had about $16.8 billion in debt on its books.
Ouch. That is a very heavy backpack to carry around.
Ouch is right. In fact, it was so bad that the interest payments on that debt were eating up nearly 95% of their net income.
95%.
Think about that. They were making good money operationally. The business was booming. The flywheel was spinning. But almost every single dollar of profit was going straight out the door just to pay the banks.
So the IPO wasn't really about raising cash to build new factories or invent new products.
Not primarily, no.
It was about fixing the balance sheet.
Exactly. It was a balance sheet repair event, plain and simple. They raised the $6.26 billion in the IPO. They took $4 billion of that cash and immediately wired it to the lenders to pay down the highest cost debt.
Okay, so that must have helped a lot. What does the debt picture look like now?
It helps a ton. It dropped their net leverage ratio from roughly 4.9x, which is getting into risky, uncomfortable territory, down to about 3.25x.
That's a much healthier number.
Much healthier. It's still not zero, but it's very manageable. And management has been crystal clear on their conference calls. Their number one priority for free cash flow right now is to pay down more debt and get that ratio below 3.0x as quickly as possible.
So they are deleveraging, and investors seem to be buying into that story. The narrative has really shifted from this is a debt-laden private equity flip to this is a defensive growth stock.
That is the key phrase right now, defensive growth. Look at the broader market. Tech is volatile, AI is hyped, but it's risky. It's speculative. A lot of investors are rotating out of that and into companies that make real things, have real profits, and own real, tangible assets.
And Medline is the ultimate defensive play.
It really is. People get sick whether the economy is good or bad. Surgeries happen regardless of what interest rates are doing. It's a safe harbor in a stormy market.
A safe harbor, but maybe not a completely safe one, because we have to talk about the risks. We've painted a pretty rosy picture so far. Dominant market share, hidden margins, locked-in growth. But there is a big elephant-sized risk sitting right in the middle of the room.
The bear case.
And it all comes down to trade policy, tariffs.
This is, without a doubt, the single biggest headwind that they face. We just spent 10 minutes talking about how Medline manufactures its own products to get that beautiful 26% margin.
Right.
Well, where do they manufacture a lot of them? A lot of that happens internationally. China, Southeast Asia. They import heavily to get those low costs.
So when trade wars heat up, and the current administration has been very, very aggressive on tariffs, Medline gets hit directly.
They get hit hard.
Yeah.
And to their credit, management has been surprisingly transparent about this. They didn't try to hide it in the fine print of the prospectus. They explicitly quantified the impact. They expect a $525 million net negative impact from tariffs through 2026.
$500 million. That is not a rounding error. That is real money coming straight out of that beautiful EBITDA we were just praising.
It is a significant hit. They even broke it down for investors. About a $325 million hit in 2025, and then an incremental $200 million hit coming in 2026.
And this directly attacks that high-margin Medline brand engine.
It's a direct assault on their most profitable business.
So that beautiful 26% margin is going to take a haircut?
It will step down. They're telling the market it will step down. Temporarily, they hope. But it's coming down.
Can't they just raise prices to offset it? I mean, everything else in the world costs more these days. If my cup of coffee costs more, why can't a surgical glove cost more?
They can, and they are trying to, but there is a very real limit to their pricing power. Pricing power in this industry is historically very, very limited. We are talking about basis points, not percentages. They might be able to raise prices by less than 0.5%, so 50 basis points, without losing major customers.
Why is it so rigid? Why can't they pass the cost on?
Because their customers, the hospitals, are broke. Many large hospital systems are operating at a loss right now. They physically cannot absorb massive price hikes from their suppliers. If Medline tries to pass on the full cost of the tariffs, the hospitals will either revolt and threaten to leave, or they'll just cut usage of certain products. So Medline has to eat a lot of costs themselves to keep the relationship.
That is a really tough spot to be in.
Yeah.
Squeezed by the government on one side and by your broke customers on the other. So what else can they do? Can they move the factories?
They are doing that too. The buzzword for it is supply chain diversification. They're actively moving production out of China and into other regions, Mexico, Vietnam, even bringing some manufacturing back to the U.S. to avoid specific tariffs. But moving a factory, especially a medical device factory, is not something you do over a weekend. It takes years, it takes a lot of capital, and it takes a ton of regulatory approval from the FDA. It's a slow process.
So that is risk number one, and it's a big one. What about the customers themselves? You mentioned consolidation earlier as a driver for their growth hospitals getting bigger and choosing Medline. But can that cut both ways?
Oh, absolutely. It is the classic Walmart effect. As hospital systems merge and merge, they become these mega systems. Think about a giant system like HCA or Ascension or Providence. When they get that big, they have massive, massive bargaining power.
They become the whale in the relationship.
They are the whale. And they can sit across the negotiating table from Medline and say, look, we know you make a 26% margin on these gloves. We think that's too much. We represent 50 hospitals in 5 states. You're going to lower the price for us or we walk.
So the bigger the customer, the harder the negotiation becomes.
Exactly. Customer consolidation can put a real squeeze on their distribution margins over time. It threatens to turn Medline from a strategic partner back into just a commodity vendor if they aren't careful.
They have to constantly prove their value with that logistics reliability to justify their price.
Every single day.
And then, risk number 3 is the debt overhang we touched on.
Yeah.
Even with the IPO pay down, they still owe, what's the number? Around $11 or $12 billion.
Somewhere in that range, yes. It is still a massive pile of debt. And it means that a huge chunk of their free cash flow, and they generate a lot, they did $1.2 billion in free cash flow in the first 9 months of 25, has to be dedicated to interest and principal payments.
Which means it's not going to shareholders in the form of dividends.
Not anytime soon. Management has been clear. no dividends.
But no share buybacks, I assume.
No buybacks either. They are off the table for the foreseeable future.
So if you are buying this stock today, you are not buying it for a yield. You are buying it for the potential capital appreciation as they pay down that debt and the underlying equity value gets unlocked.
It is a classic deleveraging play. You are betting that they can pay off the credit card faster than the interest accumulates.
Got it. Okay, so risk is defined. We have tariffs, customer power, and debt. But let's look at where they go from here. They seem to have conquered the acute care hospital. They're in the operating rooms. They're on the floors. Where is the new growth going to come from?
They call it expanding across the continuum of care.
Which is a classic, fancy healthcare buzzword. Can you translate that for us?
It basically just means everywhere else that isn't a hospital.
Yeah.
Healthcare is rapidly moving out of the traditional hospital setting. It's moving to nursing homes, long-term care facilities, standalone surgery centers, and even into the patient's own home with home health services. Medline is aggressively chasing this shift.
Why is that so attractive for them? Is the business model the same in those settings?
The model is actually better in some of these non-hospital spaces.
Better. How so?
Take a nursing home or a long-term care facility. These places don't have big, sophisticated procurement departments. They don't have a chief supply chain officer with an MBA. They rely very heavily on their distributor to tell them what to buy. They just want the stuff to show up and for it to work.
They just want it to be easy.
Right. And as a result, the usage of private label products, the Medline brand, is even higher in these settings. We're talking around 80% private label usage in a typical long-term care facility versus maybe that 60% target in a big hospital.
So the margins are potentially even juicier in a nursing home than in a hospital operating room.
Exactly. And Medline is uniquely positioned to serve all these different locations. Remember the trucks. A massive 18-wheeler can back up to a hospital loading dock, no problem. But you can't drive an 18-wheeler up to a suburban home for a home health delivery.
You will crush the driveway and take out the mailbox.
And the neighbors will call the police. Medline has adapted its fleet. They have smaller trucks. They have vans. The MedTrans fleet is diverse enough to hit every single point on that continuum. This is a huge logistical advantage that their competitors don't really have.
So if I am a big integrated health system and I own a flagship hospital, 10 nursing homes, and a home health agency, I probably want one vendor who can handle all of that with one contract and one set of trucks.
That is the N of one advantage all over again. Most competitors are really good at one thing. McKesson is great at pharmaceuticals, Cardinal is great at hospitals. Medline's claim is that they are good at the physical supplies for all of it. One-stop shopping.
And they seem to be proving this model out with some massive government wins, too. We have to talk about the VA contract.
The Department of Veterans Affairs. This was a huge headline that I think slipped under the radar for a lot of people. Medline secured a contract that's estimated at over $1 billion annually.
$1 billion a year, just from the government.
Just from one single client. They are now the primary medical surgical supplier for over 90% of the entire VA network.
That signifies total dominance in the government sector.
It really does. And think about government contracts. They are incredibly sticky. The bureaucracy is the ultimate moat.
That's a good way to put it.
Once you are entrenched in the VA supply chain, integrated with all their arcane systems, you are probably there for a very long time. It provides a very stable, predictable floor for their revenue.
What about M&A? Are they buying other companies? It seemed to be growing so well organically, but are they shopping? I mean, with all that debt, can they even afford to shop?
They are always shopping, but it's very strategic. They do what they call bolt-on acquisitions. They aren't trying to do a massive merger with a giant equal. They buy smaller, specialized companies to get a foothold in new verticals.
Can you give us an example of a bolt-on that worked?
A classic example from their history is a company called DiMed. Back in 2010, Medline decided it wanted to get into the physician office market, so doctors' offices. Instead of trying to build that sales force from scratch, they just went out and bought DiMed for about $50 million. It was a small company.
A little tuck-in acquisition.
Exactly. But they used it as a seed. They plugged DiMed into their massive logistics network. They started pumping their Medline brand products through it, and they grew it.
And what is that physician office business worth today?
Today, that segment does about $1.8 billion in revenue.
That is an incredible return on investment. From a $50 million purchase to a $1.8 billion business.
It's the playbook. They did the same thing more recently when they bought Ecolab's surgical business for $900 million to boost their surgical kitting capabilities. And just recently, they've been making moves to expand into Canada with a company called Sinclair Dental and even into animal health.
Animal health,
Yeah.
you mean? Like for veterinarians?
Vet clinics, animal hospitals. Yeah, think about it. It's
Yeah.
all the same stuff.
Gloves, gauze, cleaning fluids, drapes.
A glove is a glove, whether the patient is a human being or a golden retriever.
The underlying product is identical.
Precisely. So why shouldn't Medline sell it? It's another massive fragmented market that leverages their exact same supply chain and manufacturing base. They can put the dog supplies on the same truck as the human supplies. It just creates more density and efficiency in their network.
It makes total sense when you put it that way.
Yeah.
So let's step back and look at the whole picture here. We have unpacked the dual engines. We have seen the physical moat of trucks and warehouses. We have acknowledged the massive tariff risks. We have seen the growth strategy. What is the final verdict here? What does this all mean for someone looking at Medline today as a business and as a stock?
I think it all comes back to that virtuous cycle or flywheel that we touched on at the beginning. It's a self-reinforcing loop that just gets stronger as it spins.
So walk us through that loop one last time, piece by piece.
Okay, step one. Distribution wins the customer. The logistics, the trucks, the 99% reliability, that gets you the prime vendor contract. That gets you in the door. Step two, manufacturing creates the profit. You execute the conversion curve, you convert that customer from third-party products to high-margin Medline Brand products, boosting your margins from 5% up to 26%. Step three, profits fund better logistics. You take all that extra cash you're generating and you reinvest it. You buy more trucks, you build more sophisticated warehouses, you invest in robotics and automation, and that leads to step four. Better logistics win you even more customers. And the wheel just keeps turning faster and faster.
It is a flywheel. And right now with that $2.1 billion in new contracts they signed last year, that wheel is spinning faster than it has in years.
It really is. I think they have successfully proven that there is immense value in the boring work of physical infrastructure. In an age where everyone is chasing AI and digital assets and software as a service margins, Medline went and built a moat out of concrete warehouses and diesel trucks, and it is working.
It is working.
Huh.
But I want to leave the listener with one final thought to chew on here. We talk about the incredible efficiency of this model, the Costco model. It is brilliant. But it relies very heavily on a stable, globalized world. It relies on being able to make things cheaply overseas, whether that's in China or Vietnam or somewhere else, and bring them here efficiently.
That is the vulnerability. That is the potential crack in the armor.
Exactly. With that $525 million tariff bill coming due over the next couple of years, here's a real question. Can Medline's Kirkland efficiency outrun the rising costs and complexities of global trade? The Costco of healthcare is definitely open for business, and business is booming. But the membership fees, the cost of doing business in an increasingly protectionist world, might be going up for everyone, including them.
That is the crucial question for the next 24 months. They've clearly won the volume game. Now, can they protect the margin?
We will be watching very closely. That is a wrap for this deep dive into Medline Industries. Thanks for listening, and we will catch you on the next one.
Take care.